All right, welcome back to The Explainer. Today, we're digging into a pretty heavy financial forecast that covers the rest of 2026. And, well, according to this report, it's not looking great. The authors are calling it a converging storm. What they mean by that is they see a scenario where political, financial, and tech crises are basically all on a collision course. So let's break down exactly what that could look like.
Okay, so here's the roadmap for how this converging storm could actually play out. We're going to look at what the report calls institutional friction in America, then a major freeze-up in the private credit markets, and, of course, the big one, the AI bubble potentially bursting. After we looked at all those pieces, we'll get to the report's final verdict on what it all means.
So the whole thesis of this report really hangs on one crucial idea, that these are not separate, isolated problems. Think of it less like a few bad days and more like a perfect storm brewing. The argument is that political instability, a really fragile financial system, and a tech bubble are all going to start feeding off each other and merge into one big event by the end of the year.
So where does this all start? Well, according to this analysis, the first big storm cloud isn't gathering over Wall Street. Nope. It's actually forming in Washington, D.C. We're talking about a major constitutional clash that's apparently unfolding right now.
Yeah, the whole thing kicks off with this huge Supreme Court ruling that just came down. The court has apparently declared President Trump's broad tariffs unconstitutional. Now, that's not just a policy disagreement. That is a massive institutional showdown between the president and the Supreme Court, a real power struggle. And get this, the price tag on this decision is just staggering. We're talking about a potential payout from the U.S. government of $175 billion. That's money that would have to be refunded to importers. I mean, just think about that. It's an enormous, completely unexpected hit to the national budget. A real fiscal shockwave. So the report puts a name to this problem, drawing on a theory called institutional economics. The idea is pretty simple, really. A country does well when its institutions are inclusive, meaning power is spread out and there are checks and balances. But it starts to fail when institutions become extractive, where a small group just concentrates power for itself. The report is basically saying this clash between the president and the court is a huge red flag that the U.S. is tilting towards that more dangerous, extractive model. Okay, and this is where the report goes beyond just opinions and gets into the hard math. They're not just saying, hey, political fighting is bad for the economy. No, they're using these really complex econometric models, you see one on the screen here, a VECM model, to try and actually quantify the damage. You'd normally expect things like tariffs and inflation to have a pretty stable, long-term relationship. What this model is showing is that this institutional fight is literally breaking those connections, throwing everything out of whack, and making the whole economy way, way more unpredictable. All right, let's pivot to the second storm cloud. This one's brewing in a corner of the financial world you might not hear about every day, the private credit market. Now, this isn't some small-time operation. It's a massive, multi-trillion-dollar system that kind of lives in the shadows, outside of normal banking rules. And this report is basically sounding the alarm, flagging it as a huge systemic risk. And it seems like the first domino has already fallen. The report points to a specific event, Blue Owl Capital, a huge name in this space, just slammed the gates shut on one of its major funds. They've permanently halted redemptions. In plain English, they told investors, sorry, you can't have your money back. As you can imagine, that sent an absolute shockwave through the industry, and you can bet other big firms are feeling the heat. And again, it's the sheer scale here that's so frightening. This isn't some tiny niche market we're talking about. The private credit world has exploded to almost $2 trillion. And you have to remember how it got that big. It all happened during that long era of super low interest rates, when money was basically free and regulations were, well, pretty loose. The report has a name for this: malinvestment. It's a concept from the Austrian School of Economics, and it's pretty intuitive. The idea is that when interest rates are held artificially low for a really long time, money gets poured into projects that aren't actually viable. They only look like good ideas because the cost of borrowing is so cheap. The report uses the analogy of building a skyscraper on a weak foundation. And what happened at Blue Owl? Well, the analysis suggests that's the first major crack we're seeing in that foundation. And that brings us to the third and maybe the most explosive storm cloud. We're talking about AI. For the last couple of years, it's been nothing but pure optimism and a fire hose of cash. Well, according to this report, that party might be coming to an end as all that hype starts to collide with some very harsh realities. I mean, just look at the numbers being thrown around. They are absolutely astronomical. The report highlights this potential deal where NVIDIA might invest in OpenAI at a valuation of $730 billion. The report's position is pretty blunt. That number is just completely untethered from any realistic path to actually making money.
So instead of just guessing, the analyst actually ran the numbers. They used a sophisticated model. It's called a Monte Carlo simulation, which basically runs thousands of different versions of the future to see what's most likely. They plugged in OpenAI's insane spending plans, and the result? The model says there's less than a 12.4% chance the company will actually be making money, positive cash flow by 2030. The conclusion is pretty clear. The math just doesn't work.
It's not just about the spreadsheets either. The report argues there's a big shift in what it calls the social mood, and this quote is their Exhibit A. We're talking about the new head of Xbox, a part of Microsoft, one of the biggest investors in AI, coming out and saying they will not fill their ecosystem with soulless AI slop. Wow. When a major tech leader feels the need to say that publicly, it's a huge sign that the initial, wide-eyed hype is starting to turn into some serious public skepticism.
Okay, so this is where all the pieces click together. This is the convergence. The report's big argument is that the political mess in the US, the credit markets freezing up, and the AI bubble popping aren't going to stay in their own lanes. They're going to merge and create a cascade effect, triggering a synchronized global downturn. So what does that actually mean for your portfolio? Well, the report gets very specific with its year-end forecasts. For the US markets, it's predicting a pretty painful correction, a drop somewhere between 15 and 25% for the S&P 500 and the Nasdaq. But look over at South Korea's Kospi. The forecast there is even more grim, a potential drop of 20% or more. Why? Because their entire economy is so deeply tied to semiconductors, and if that AI spending bubble bursts, they're right in the blast zone. Now, what about currencies? In times of global stress, money does one thing. It runs for cover. And that usually means the US dollar. So the report forecasts a classic flight to safety, which means the dollar is going to get stronger. The flip side, of course, is that other currencies get weaker. They specifically call out the Korean won, which would get hit by capital flying out of the country, and the euro, because the European Central Bank is likely going to cut interest rates before the US Fed does, making the euro less attractive. All right, so let's pull it all together. What is the final verdict from this report? Well, it's pretty sobering. It's not just predicting a bad year, it's suggesting the entire financial world is about to change in a fundamental way. The term the analysis uses is a capital winter. They believe this combination of political decay, a major credit crunch, and a popped tech bubble is going to usher in a long, cold period where capital, money for investment, becomes really scarce and everybody just wants to play it safe. And this is probably the most important takeaway. The report is adamant that this isn't just a normal downturn, a dip we'll recover from in a few months. It's arguing this is a massive structural shift. The whole era of easy money, cheap capital, and wild speculative growth, that's over. And what replaces it is a much colder, much more cautious financial world. So there you have it. It's one possible future, of course, but it's a sobering one, all based on the report's models and data. And it really leaves you with a big question to chew on, right? If these are the storms the experts can see forming on the horizon, what other forces, the ones that are still invisible, are already shaping our economy right now?